Can we talk about numbers, money? So you've raised, how much money have you raised over the period that you've been getting Phoenix up and running?
Well, if we look at Wheeler, historical costs, we've spent, as a JV, we've spent $100 million plus on finding those deposits and moving them forward.
Okay. Right, and you've raised money just consistently over, each year you're dipping into the market. You did another raise in December, I think. Or was it November? December, I think.
Yeah, the money we spend matches the project, right? So we've raised big bucks for exploration when we've had a deposit to delineate.
Yeah.
And we're raising smaller amount for exploration now because we're actually focusing more on discovery of new ISR-amenable deposits. And so we're not going as deep into the exploration side of things because really the value creation is going to come out of developing Phoenix. And we don't really want to be diluting shareholders with big exploration budgets right now. But we do want to keep our mind and our team focused on finding additional ISR-amenable deposits because we do think we have an advantage on that front and can add a lot of value.
Right, there's exploration happening as well. That's good. Is part of that 100 million, is that 20? There's a $24 million credit facility in there as well. By is it Scotiabank, or was that separate?
Yeah, the 100 million is a historical spend on Wheeler. When you look at that $24 million credit facility, so that's a letters of credit facility, and we issue letters of credit off of that facility to secure our reclamation obligations at McClean Lake, right, where we have historical mines that have been mined out, and of course we have the McClean Lake Mill, which is licensed and operating and processing all of that ore for Cigar Lake.
Oh, fantastic. And part of that deal is you need to keep $9 million in cash on deposit at all times, and you're not having any issues with that. That $9 million is there.
Yeah, it's restricted. It's held by Scotia on our behalf,
right.
and basically that covers part of that credit facility. You got it.
Right. Okay. What is the cash position today outside of that $9 million?
Yeah. So we reported Q3 cash just around $10 million. So
yeah.
That would be the unrestricted cash.
Right, and the burn rate. I mean, when does that? I'm guessing where I'm getting to is, are you going to come in back into market anytime soon? And what sort of quantum you're looking to raise at that point?
Yeah. So we raised 4.7 million Canadian in the fourth quarter. That would be on top of that 10 million. At the end of the day, we're a development company. So while we do have sources of cash flow from Uranium Participation Corp and from our environmental business in Northern Ontario, and we've got a contract with BHP up there where we take care of their closed uranium mines. But while we do generate some cash flow from that, we're going to need more money. It's a development company. The key with us is that we're very fiscally prudent. We really do plan our activities out, and we really do have a path to finding the right window of capital. It's an interesting thing when you have a shareholder like Lucas Lundin. You manage your dilution carefully, because at the end of the day, Lucas Lundin and frankly myself, and money that I've invested in the company, we're not going to make a return, the type of return we want to make, if we're swamping our shareholders out with big equity raises that are poorly timed. Now, that said, there's always a tension between moving the project forward and the value of bringing that production forward and being on time. Because every year that your start date moves, you're affecting today's NPV, right? So we'll always be juggling that. We certainly don't love equity at these values. We'd look at other asset disposals. We'd look at other ways to raise money that aren't linked to the share price.
Okay, so let's look at that. You had about $10 million in your September statement. You burned about $1 million a month prior to that. Is that right? Basically, I'm trying to work out what you've burnt between then that statement of $10 million and today. It seems to be, to me, $3-4 million would have, been spent on the development activity. I'm trying to get a sense of where you're at today, and I know there's probably a December statement coming out soon, but where are you at with the cash?
So we'd say that our year-end statements are coming out, but look, at the end of the day, when you look at the spend, we disclose our plans for the year crystal clear in our MD&A, and we're really one of the only developers to do that. But you have to understand that year-to-year plans change. And so the scope of spending really is variable to a certain extent and adjustable to the cost of capital, right? So I would caution against using, say, 2019 and the monthly burn as a proxy for 2020 and the monthly burn. What I can say is that our sort of G&A overhead costs are in the range of $5 million Canadian, and we generate somewhere in the range of $2 to $3 million Canadian in cash flow from running Uranium Participation Corp and from our environmental business.
Tell us about those, because I'm trying to I was focusing on the spend, but you do have some incomes from a couple of sources. Can you just tell people about those?
Yeah, so we've been the manager of Uranium Participation Corp. So this is a publicly traded company on the TSX under the symbol U since its inception. And this is a company that holds physical uranium, has about 18 million pounds U3O8 equivalent in inventory. And we are the administrative and commercial agent or manager for that company. And so independent board of directors, they've hired us. We have a 5-year contract with UPC, and we get paid a base fee plus a variable fee that changes based on the net asset value of UPC. So the higher the uranium price and the higher the value of UPC, the more money Denison's going to make managing that.
What do you get from them? How much do you get from them?
We'll earn about $2 million Canadian a year managing Uranium Participation Corp.
Okay.
And really that's all about leveraging our experience in the space and our reputation. Because when UPC was formed, over a decade ago, it wasn't that easy to go set up storage accounts to buy and hold physical uranium. And so that was really the marriage there, was saying, look, Denison is a known player in the space, has these commercial relationships with the converters and the enrichers, and we could actually go and set up those accounts for UPC and use our commercial knowledge in the uranium space to actually manage UPC's inventory. So that's UPC. If we go to the environmental side, we have a closed uranium mine in Elliott Lake, Ontario. It's very famous in Canadian uranium mining. That district would have been the Athabasca Basin before there was an Athabasca Basin historically. And we've closed and fully reclaimed that mine, which is quite an accomplishment. And actually, the mine is used by the CNSC to tour people from Canada and internationally to show them what a closed and fully reclaimed mine can look like and a success story. So with that, we have a team of people up in Northern Ontario that take care of our site, but we also have a contract with BHP, and they've acquired a company along the way that had a number of closed uranium mines in Northern Ontario right around our mine. And so we offer them care and maintenance service, like what we're doing at our sites, but for their sites, and we'll earn somewhere in that range of $1 to $2 million from that business segment, not just from BHP, but from that business segment.